Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys!
It's November 30th, 2018, episode number 4 of the Market Huddle. This is Patrick Ceresna.
And I'm Kevin Muir. If you're tuning in for the first time, thank you for taking the time out to join us. The Market Huddle is a weekly show where Patrick and myself get together over a couple beers to talk about the week's action in the market, making sure to keep each other's feet to the fire and have a little fun in the process.
In this week's episode, we're going to touch on the most important things that happened this week. Did we see a key market bottom? Did Powell blink?
In our This Week in Trading History segment, we remember back to the Enron fiasco. For this week's WTF clip of the week, Kudlow's recent press conference.
In our Tales from the Trading Desk, we're going to look back at a story from our early trading years, and then we're going to end with the top 5 most important things to watch next week. Let's jump right into it. So, Kevin, who's our sponsor this week?
Well, this week's episode is brought to you by Cowbell Brewing. The Shindig beer is the craft beer that rings true from Huron County Lager. So let's try.
Let's give it a shot.
That's quite nice.
It is. Listen, I'm going to enjoy this beer. Well, you give everyone that ridiculous disclaimer you have to say every time we're on this show.
Okay, here we go. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com.
All right, Kevin, let's get right to it. What was the most important event of the week for you?
Well, by far and away, the most important event was Powell's press conference. This was a highly touted press conference because the week before, the Fed had issued some slight signals that showed an indication to maybe back off their recent hawkish policies. And the real question was, market participants were on pins and needles wondering, did this actually reflect a change in Powell's sentiment or the Fed's sentiment going forward?
You know, I had this conversation with Eric, and he more or less didn't feel that things changed that much in his language, but you have a slightly different view. I wanted to hear your perspective here.
Well, I do have a different view. I do believe that a lot changed this week, and it was very important. Let's go back to October 3rd. Back then, Powell had made a comment, and it was actually in front of a PBS. Judy Woodruff was actually interviewing him, and he made a comment that was taken by the market as extremely hawkish. And I'm going to read it to you. The really extremely accommodative low interest rates that we needed when the economy was weak, we don't need those anymore. They're not appropriate anymore. Interest rates are still accommodative, but we're gradually moving to a place where they will be neutral, he added. We may go past neutral, but we're a long way from neutral at this point. And this was October 3rd.
There's a lot of things that happened back then.
Yeah, but the important thing to realize is that the market interpreted that last bit, we're a long way from neutral, to imply that there was a lot more hiking to come.
You're right, because if you go back then, they were pricing in the euro dollar markets almost 60, 70 basis points of potential rate hikes in the 2019 year.
And it got worse from there, from that comment. And what I want to show is I've got a series of charts, though, I want to go through. And we're going to start with the 2-year TIPS yield. And what is this? So this is the yield that you receive on a 2-year TIP, which is a Treasury inflation-protected securities, above the cost of inflation. So one way to think about this is it's the real yield. It's what an investor would earn after inflation for the next 2 years.
Yeah.
So if you have a look at this chart, you'll see that it was kind of bouncing around for the previous, basically from the summer. It was between 100 basis points and 90 basis points. It just kind of hovered around there. Then October 3rd came. And what happened? That 2-year TIP yield went from 90 basis points to 155. So there was
It was a huge spike.
It was a lot of tightening. It was 65 basis points. And the important thing to realize, it was real tightening, meaning it was tightening above inflation. That was all that the market started to price in. And what did that tightening do? It caused all sorts of problems throughout the market. And you'll see the next slide, which is financial conditions. Financial conditions were actually loosening going into the summer and were looking good. And then again, Powell did his comment and they all of a sudden tightened. The next thing that we want to look at is credit spreads. And here we go. We have the Barclays high yield 10-year credit spread. So this is the amount that a corporation pays over government bonds, like in terms of yield spread, to borrow money. And you'll see that went from 310 basis points before Powell's speech. And then when we click the next slide and we have a look, you'll see that it spiked 100 basis points. And look to the day. Look at the day it happened. It was every single day since then. There was just all sorts of tightening.
And it was this chart that I watch a lot with my members, talking about when this blowout occurs. Like if we saw a period where we'd surpass 4%, it would be a very good indication that the markets are heading toward a recession, or at least the bond traders are starting to price in the potential of an economic slowdown.
Right. Let's go on to the next slide, because the next one's even more interesting. It's going to be crude oil. And we have a look at the day that crude oil topped. Guess what day it was?
October 3rd?
Yeah. And it's been straight down since then. So we've gone from $77 or whatever that number was down to $51 since Powell's speech. And it's not just crude oil. It's also, let's go to the next one, the S&P. Again, it wasn't the high, but ever since then, the market's been going down.
It's almost like intermarket analysis actually works.
Well, or it's almost like
Fed matters.
The Fed matters,
Yeah.
and that Powell... I always said that the Fed was going to raise rates until something broke. And I think that what happened this past month and a half is that they raised rates to a level where it actually broke some things. And we saw that in credit spreads, we saw that in crude oil, we saw that in financial conditions, and we saw it in the stock market.
How intentional do you think it was what they did?
Well,
do you think he meant to spook the markets?
So I think that they don't know what the correct price of money is. Nobody does. To them, they
adjust, and then they adjust, and then they see how the market reacts, how the economy reacts, and then they adjust again. Right? They're always reactive.
That's right. So did he plan on making something break? Yes, he was going to raise rates until the economy started to slow, because if they're looking forward, the unemployment's really low. There's all sorts where the economy's doing well. There's the fiscal expansion. There's all sorts of reasons why they should keep raising rates. But does he know that this is going to be the one that actually causes the pain and the problems? No, they don't have a clue when it's going to happen. Nobody does. But the thing to remember is that there's going to reach a point where the markets, who are much smarter than any one economist or anybody on the FOMC or even any hedge fund guru or anybody else, the markets collectively know when we've hit that point.
So now let's go on and actually touch on, though, that a few days ago there was this idea that Powell blinked.
Right. So going into it, 2 weeks ago, they had done a few they'd given some hints that they might be switching, that they were watching and there might be signs. And a lot of market participants believed that there was a chance that we were just reading too much into it, and that the Fed was still on track, and that nothing was going to derail their hiking. And yet the Fed came out and gave some hints. It started with Clarida, one of the FOMC board members, gave a hint, a speech. And then we had a chance where both Clarida and Powell had meetings this week, or press conferences this week, and they had a chance to either reassert their hawkish, policies, or say, yes, things have changed. And this is what happened. Powell came out and said, interest rates remain just below the range of estimates for that level that would be neutral for the economy. So let's just stop and think about this for a second. 2 months ago, he's telling us we were a long way away. And now he's saying interest rates remain just below the range of estimates for the level that would be neutral for the economy. So what I interpret that as, that means that we're going to have one more hike in December, and then they're going to go, and they're going to be truly data dependent. And does that mean they're going to lower rates? No. Does that mean that the next move is that they're going to pause? Not necessarily. But it does mean that they're off of this every second meeting hiking schedule. And that's the part that I disagree with everyone who's saying this isn't a big deal. Because up until this point, the Fed was consistently saying we are hiking every second meeting. We're still a long way away from the neutral level. So therefore, expect a hike every second meeting. And so I think that it's important for investors to realize that I'm not saying that we're going to go and we're going to cut rates. I'm not saying we're going to pause. We might keep going up. I don't know.
It's just that they're going to be data dependent.
That's right. And not only that, ask yourself, if you were to pause and if you were to lower rates, let's just assume that after this December meeting, because the December meeting is going to be a hike. But if you were to go after that and pause and then maybe even cut in next summer, what would be the first step? The first step would be to take back that every second meeting hike commitment that you've done. So where people tell...
But the market is responding very bullishly to this, obviously.
Well,
and my thinking here, though, is that we're now seeing a Fed that is torn between doing what they think is right from a monetary perspective to that they're becoming political, where they're realizing that they don't want to piss off Trump. And in my mind, if they basically tightened too much and the economy fell into a recession, who do you think the fall guy would be? Who do you think Trump would want to head on a platter?
Yeah,
it would be Powell, right?
Right.
Am I right?
No, you're...
So the question then is that, are they just saying this to appease Trump?
So are you trying to argue that they're
being political?
Well, no, I'm not disagreeing with that. But are you trying to argue that they're still going to raise rates just as aggressively as they would have a month ago?
Not necessarily. I think that what they're doing is they're realizing that they damaged the confidence of investors with their last statement, and they're realizing that if they don't backtrack on what they said, that there would be a price to pay.
Well, and I think that what they're realizing is that they tightened too much, that they had gone and pushed too far and something broke. And now they're going to be truly data dependent. They're going to wait for the economic data and they're going to see what happens.
So there's a rate hike in December. Agreed?
Agreed.
That's already been baked into the cake. I mean, the market's already priced that in.
That's right.
But what's your over-under that we have a March rate hike at this moment? Obviously, we're going to look at the unfolding reality before us. But what is your over-under for that there's going to be
I'm a huge seller that we're going to have a March rate hike. Huge seller. I think the chances are very low. I think that they're going to be a one and done, and they're going to be on hold for the indefinite future.
All right, let's move on.
Okay, Patrick, I'm sure people are fed up of hearing about me blather on about the Fed. So what do you think was the most important thing this week?
Well, to me, I wanted to ask that very important question. Was that a key market bottom that we saw in the markets? Obviously, Powell's comments had a very important part of that, right, in terms of turning the sentiment. The market was already slowly edging higher on the news, and then suddenly the real boost in the markets here. Let me put up a chart of the S&P 500 here. That kind of this candle boost that happened right over here was very much on the reaction of the November 28th Powell event. And so the market took off. We're actually going into, obviously, the G20 weekend meetings on a pretty strong note. Obviously, many people are trying to, I guess, give the benefit of the doubt that there's going to be some sort of de-escalation of the trade tensions.
Well, not only that, you had Powell, and then this today, which is Friday, we're taping this Friday night, the Trump and Xi were kind of sending out kind of like warm, fuzzy feeling kind of communiques like about this to expect a deal this weekend. So definitely the market is pricing in a chance of a good deal.
Okay, so I've been in the camp that we're in a bear market in the bigger picture. And to me, there's going to be bear market rallies that are going to always come in with some velocity. I'm still in the camp that we're not going to see higher highs in the stock market. But if a trade deal was to happen, what's your over-under that we have still a big leg higher coming up in the first response?
Well, the initial knee-jerk will definitely be higher. And then the real question is, does that thing fade by like that afternoon? Do you get a situation where the S&P opens up 30, 40 points and then they start selling it? I think that it's going to depend on the deal. And I don't think we're going to talk a little bit about the deal when it comes to Kudlow's recent press conference. I don't think we're going to get a real humdinger of a deal. I think we're going to get a deal that just does its best to try to make it so that Trump can save some face and get the stock market going.
I don't think that he's going there to bully China at that meeting. At that meeting it's about shaking hands and giving everyone the impression that that the door is always open, that if they're willing to come to terms to the way that the U.S. wants to do it, that there's room for that. It'll be interesting. I'm not convinced that the rally will be long-standing. I wanted to talk about some key technical levels for our listeners.
The squiggles.
The squiggles, for
Here
sure.
we go.
And so where are the squiggle lines? And so for me, actually, we just broke it right here going into the close. But to me, the 2750 level was an important line in the sand for a bull-bear sentiment, because in my mind, a failure below 2750, that was where the Fibonacci zones lied from the previous sell-off. Any price action in the stock market that remained decisively below this level would continuously demonstrate very distributive price action, where the selling is just coming in, hammering any attempt that the buyers are coming in. But really, if we start off with a gap higher on some positive news from the G20, and we, let's say, are heading right up to the highs that we were in at the early November, up around this kind of a 2820 area on the upside. To me, that is a sign that whenever you wipe out the entire last leg of selling, that means that the buyers have velocity, that there's liquidity that's being squeezed in there. There's a lot of CTA buy models that trigger and are suddenly flip from being 100% net short to being neutral to even being net long the S&P as soon as they get their signals. And of course, there's all those people that spent basically 3 weeks getting the hell out of the stock market, and now they're completely on the sidelines, and they're realizing this market's running away, and they got bamboozled into selling, and they're chasing the market. There's always these liquidity. It's the behavior of the animal spirits in the markets, right?
Right. But going back to your comment, you believe that we're into a bear market. And the one thing that I've learned in bear markets is that the spikes are vicious. They're big, and they suck you in. They think it's going to go. You think this will be the one, and you think it's going to take off, just like you remembered in 2016 and 17. It was so great, and that's what happens. And then by the afternoon, the selling comes back and it closes down. And that's, to me, the hallmark of a bear market.
That's called reading the tape. What you're looking for is the behavior of investors when, you call it squiggles, but when there's a technical level broken, to me, it's a beautiful moment where the market is going to give you a tell. It's going to give you a tell because what happens, it's almost like baiting in something. You basically give all the technicians the bait. You break a level, and then you see whether everyone in the market is going to buy it. And if you bait them in and everyone rushes in, you know that there's enough buying pressure to keep the market going. But if you bait them and no one shows up to the party, then you know it's about to get hammered, right? And this is why it's going to be so interesting whether or not this is buy on rumor, sell on news on G20.
Well, first of all, when you started saying baiting, all I could think about was idiocracy, and you kind of got me scared there. But anyways, I'm actually concerned that we're going to have a situation where, you love your squiggles, you love the breakouts, you love going with them. To me, some of the best technical patterns are technical patterns that break, meaning that like a breakout that fails.
Right.
So I would actually watch, and I'm not predicting this, but one of my favorites is I call a pop and drop. So you get a pop above a level, you get everyone getting in there, you get all the technicians, drooling all over themselves, saying how great this is, and then what happens is it drops back into the level. And to me, that's
a big tell. For my members, we call that the prairie dog, the prairie dog.
I like that. Being a Winnipeg boy, I like the homage to the prairie dog.
Exactly,
a noble creature.
And so we have is a scenario where the market pops it like a prairie dog above the ground.
Yeah,
looks if there's danger. If they doesn't like it, pops back down.
That's awesome. I love that.
And so we're always looking for that's a big technical tell.
Oh,
and so I'm completely on board with you. So I want to move on though because I prepped a couple of charts and you have some great insights on this, I'm sure. What I wanted to talk about, Numera put out these two charts on the S&P combined delta versus spot, and then they also showed the S&P combined gamma on a 1% move. Now, a lot of our beginners are not sure what we're talking about, delta gamma, but when you're dealing with the options market, just a very quick primer, delta is telling you the rate of which the options are behaving like the underlying stock. And dealers are always striving, in many cases, to be delta neutral, which is they want as little exposure while they're making a market. And gamma is the rate of which the delta is changing on them. And so, and often dealers are short gamma.
They'll be short at different parts of the curve, but
yes.
But on the whole, you are correct that that most clients are buyers of options, so the dealers are generally sellers.
Right.
Now that's changed lately with the nature of more sophisticated players entering the market, but traditionally that was the case. So Nomura's charts here, what they're trying to show is what the exposure is of those dealers that are making markets in for these clients.
Right. And what's interesting to me is that if you look at the gamma one on the right-hand side, we're seeing that it gets very aggressive to the upside towards 2,800, but then kind of levels off and almost flattens because I guess the delta at that moment's already approaching 1, and you're going to have less impact on the overall move, right?
It's actually that's measuring the gamma, the
right.
total dollar gamma. So what they're trying to show is that not a lot of clients have sold them options above at those strikes. Right. So just the reason why this curve exists is that traditionally clients come into the S&P and they want to buy puts for protection. And one of the easiest ways to pay for those puts is to sell calls. So they'll go, and if you're a portfolio manager and you're long a whole bunch of stocks, so you think you're a great stock picker, but you want to go and you want to hedge that up, you'll go buy some puts. But the problem with buying puts is that it costs you money. Yeah. So what they do is they sell some calls. So that's traditionally why the dealers' books look like that. So what the important thing to understand is that as the stock market rallies, those dealers are actually having to sell more stock because they're long gamma. And then the other interesting thing is as the stock market goes down, those dealers are actually having to sell stock because they're short gamma.
Right.
So it's kind of an interesting phenomenon.
It is. And so in my mind, these dealers, but I mean, this is a situation dealers are always faced with. I guess it's really what's more relevant is the size of their exposure for a 1% move, because they're always going to have that short gamma. But if their impact of a 1% rise is only 5,000-6,000, it's a lot different than 20,000, right? And
that's correct. And the other thing is, at what level are they long gamma? At what level are they short gamma? And that goes back to when you talk about the CTAs and that they're going to be selling or buying at certain levels. These dealers will also be affecting it because these gamma moves will actually cause some ripples in the market all the time as the dealers are forced to hedge.
So I want to move on to one last chart that to just touch on, and that's looking at the skew on the CBOE. Again, we're dealing with the S&P 500, but the skew is all about the shape of the not term structure, but the
volatility,
the vol structure in the skew on options, which is tail risk tends to have fat tails, and they're pricing higher vol premiums on those tails. And so when the skew is really high, there essentially we can extrapolate, correct me if I'm wrong, that the vol premium on those tail hedges are very expensive.
That is correct.
Right?
Yeah.
And when we have this chart normalizing back down to the bottom of the range, it means that, I mean, are you going to try and make the argument that it's less demand for tail risk?
That's how I would interpret it. And that people are paying up, the clients are generally paying up for those puts, and as the skew comes in, that means they're not willing to pay as much for those puts relative to the calls.
Yeah, that's the key. Is
and
that the skew is normalizing between puts and calls.
Right, and you might. My initial gut was that must mean that the stock market is vulnerable. It means that clients are bullish because they're not going out and buying all sorts of protection. And interestingly enough, at sentimenttrader.com, Jason, I can't remember his last name. He's a terrific follow. Everyone should follow him on Twitter and look into his product. He's gone and looked over the last 9 years when the skew has fallen down below 120. Sorry, the next year's annualized return is on average 38.9%. So what that implies is that when customers are no longer buying that protection, that means that the next year's return in the stock market is actually quite high.
You know, I'm going to just kind of pose it because I have no evidence. I never did any research on this. But what if the skew is being thrown off just by a much larger demand for calls that normalize the skew, as opposed to this being less demand for the put? Like, what if this is more of a tell from the fact that let's say if I'm a hedge fund manager and I'm being forced to deleverage my portfolio, let's say compliance is up my ass, and I'm running a portfolio that's being varred to death, and
it's not compliance is after you; it's the risk committee. The risk committee,
whichever
okay.
one it is, they're after you, and so you're de-risking. But at the same time, you're scared that you are selling at the bottom. And so what do? You hedge right tail risk by buying call options because you're basically reducing your beta and you're reducing your overall portfolio weighting. So why not buy calls to limit that risk, but yet give you that upside? What if that skew is being mutated by that?
It might well be that's the case. It sounds like a great study for us to do in the future.
Absolutely. So let's move on. Kevin, it's time for This Week in Trading History. And so for this week, we decided to feature Enron.
Yeah, at least it wasn't another crash from 1907.
Yeah, it was no more 1907 crashes. We'll wait till next October to feature them all over again.
That's right.
But right now, actually, the filing of the bankruptcy of Enron occurred on December 2nd. So we're just a couple days early on this one. But what a story.
It was just unbelievable.
I started my trading career just literally a few years before this happened. And so I was so confused that, Enron was at one time, wasn't it like the seventh, not largest, but it was in the Fortune 500. It was like it
was a large cap, very respected stock, and they could do no wrong. Like they people thought they walked on water.
I just can't believe that a huge company of that magnitude could get away with something as significant as this. Nonetheless,
like that never happens today.
No, certainly not. But the CEO at the time was Kenneth Lay. He then passed it on to
Jeff Skilling.
That's right. And both of them were doing some crazy stuff. But I think what we should do is actually one last thing, and then you have a video that we want to show everyone. Yeah. But really fell apart when Dynegy was going to buy them out. The whole thing was crumbling, and then they actually looked at their books. and they realized we can't buy this company out.
Well, they were trying to save them on the way down, but they had already gotten themselves into a whole lot of trouble. And it was interesting to see the cracks. Let's play this video, and it's
before we play the video.
Okay,
I want to though touch on that the degree of this, because the 5th largest accounting firm in America, Arthur Andersen, was cooking the books with them. Enron brought down
it was off-balance sheet items. It was actually very similar. I believe the Lehman stuff was these off-balance sheet swaps, and it was kind of the same kind of deal. Anytime anything's off-balance sheet, you're kind of, whoa, what's going on here? But you're right, Arthur Andersen, it took them down, and I think that they also ran into a lot of trouble from this.
Yeah, absolutely.
So let's play the video, because the video you're going to see a very interesting fella there that I think this really made his career. So let's hit it.
And then Jeff Skilling took questions. And about midway through the session, there was a questioner who was sort of aggressively wondering out loud why it was that Enron, as a financial services company, in effect, could not release a balance sheet with its earnings statement like most financial institutions do.
You're the only financial institution that can't produce a balance sheet or a cash flow statement with their earnings.
Well, thank you very much. We appreciate it.
Appreciate it.
Asshole.
And then quite audibly, you could hear Skilling say, asshole.
So, Patrick, I watched Enron way back when, and it was really the episode that cemented in my mind one of the greatest investors / traders that I've ever met. And he doesn't get enough kind of accolades because he's a short seller.
Right.
But Jim Chanos is just by far and away one of the smartest guys. When Jim Chanos tells me or says that he's short a stock, and I'm long it, I go back and I take a really good look at it, and I most likely will get rid of it.
I wonder if Fidelity is thinking twice about their Tesla investment. After Chanos has started this whole operation.
And correct me if I'm wrong, but when I've seen him, there's a lot of guys, last week we talked about Ackman making a fool of himself with some short, and there's other guys that have been trying to, go and put people in their bullets, in their sights and shoot them. When Chanos does something, I've never seen him be wrong. And I know that's I'm sure someone might be able to tell me and send me stuff, but I'm telling you that if that guy is short your stock, you should watch out. And what a great story, because he was one of the big shorts. He really made his name on that. He made himself a household name, along with Jeff Skilling. I still remember sitting on the desk and someone telling me, oh, Jeff Skilling just called someone an asshole. And I was like, well, what's the big deal? We do that on a trading desk all the time, but we aren't the CEO on a conference call. So it was pretty exciting stuff.
Crazy.
Yeah, no, and it was a terrific story. And there's lots of great books. I think Bethany McLean has got a great one, The Smartest Guys in the Room. And so it's a great story, and we really I encourage people to go have a look.
I want in one of our future episodes, we got to talk Tesla. We got to, because Chanos has some great clips about what he thinks Tesla is worth. Spoiler alert, it's zero. But I think that it's just going to be a great story.
Well, that's great. Looking forward to hearing about it.
Okay, let's continue.
Okay, Patrick, time for the WTF clip of the week. I made this one, and I must say I had a little bit of fun with it. First of all, Kudlow, he's great. He's just so much material there for you to work with. So without further ado, here is our good friend Larry Kudlow at his recent press conference.
We have a very strong holiday season, so-called Black Friday, very strong. We've had tremendous investments, business investments, energy investments, oil prices and gasoline prices coming down. That helps consumers, of course. We're in very good shape.
Bernie, baby, movie, get off your asses. Party time!
China, not so good.
Hi, Bernie.
I'm not here to critique or second-guess the Chinese economy.
I just made it over for the weekend, and I had to give you regular time. Thanks, Klaus. I got it.
But most observers believe China to be in a slump.
Watch the wing! No! Watch the wing, Richard!
Whereas the United States is in a very strong, solid position going into this summit.
You're doing very well, Richard. Sorry I snapped at you.
No, it's okay.
I mean, I've never been chased by a killer before, you know?
No, it's all right. You're doing very...
However, again, to repeat, the president said there is a good possibility that we can make a deal. And
Why is everybody waving at us? I'm popular.
he is open to it. But on the other hand, if these conditions I mentioned a few moments ago are not met, not dealt with, you know, the president has said, look, he's perfectly happy to stand on his tariff policies.
Do you hear something?
Which 10% last $200 billion, scheduled to go to 25%. That's not a certainty, but that's the schedule.
I wonder what that is. What is that? Man overboard! What? Stop the boat! Oh, Bernie!
And he has said, as recently as yesterday, the day before, if need be, if things don't work out in this U.S.-China summit meeting, he will invoke another 267 some odd billion dollars in tariffs.
You had maybe one job to do.
Well, let's not argue about it, Richard, please.
Jesus.
Oh, my God.
What?
You lost my sunglasses.
All right, Kev, you picked this clip. I'm going to let you take the first punch here.
Larry, I just kind of shocked at how arrogant he is in terms of him going into this thinking that the U.S. is so strong and everything is so terrific and everything is so bad in China. And it just, when he said we're in good shape, it just let me I couldn't help but think Weekend of Bernie's. That guy was in good shape too. And I don't know. What do you think about their arrogance or their confidence?
Well,
maybe arrogance is the wrong word. Their confidence about that
this
their
is
economy is doing so well and that the Chinese economy is doing so poor.
Yeah, this is par for the course. When you're in a political situation like that, even when you're losing, you're going to say you're winning. And I think that this is just theater. The real situation, you have to be able to, when any political figure, and Powell included, whenever they're speaking, you have to learn to read between the tea leaves. You have to ask yourself, what are they saying and why do they have to say it right now, rather than actually listening to the words themselves?
Well, Patrick, I couldn't disagree with you more.
All right.
I think that this is much different than most other administrations. They are confident. They are sure. Now, I think Kudlow's like that. Navarro's like that. A lot of them are confident that China is like Russia. During the Reagan broke Russia through spending, and it was just a matter of time, and their economy collapsed. And I am confident that is what the trade hawks in the Trump administration believe. So I will take the other side of your trade, that this is just politics, that this is just what every single Treasury Secretary, no, he's not Treasury Secretary, whatever he is, Commerce Secretary, that they say this isn't normal, this isn't par for the course. But the real question I have is this what Trump believes? And is Trump going to follow it through? And I don't know that answer. I believe that 2 months ago, he was ready to drive a hard bargain. I personally believe that the Americans are much more sensitive to the short-term squiggles, for lack of a better word, of their economy, but more importantly of their market. Trump has tied himself to the stock market. I think that China, Xi Jinping, he's gone and
Xi Jinping, okay,
yeah.
He's gone. This is going to be an ongoing thing in every episode.
Boom, boom, pow. So he's gone and he's actually he's made himself the leader for life. To think that he's worried about the stock market or the economy for the next quarter, year, or 2 years. It doesn't matter. He can take the pain way more than Trump and those guys can take the pain. Yeah. And listen, whether you think that America is in a stronger position than China, or whether you think that China deserves it. I don't know. I don't care. I really don't. I'm not here to tell people who's right, who's wrong. Go on the internet. There's a million people that do that. But I will tell you this. I'm still really scared that when you have two big kind of market players that both believe they have the strong hand, that they will go and they will both take it to the wall. Now, I think over the short run, this is kind of contradicting what I believe is going to happen this weekend. Over the short run, they both have incentive to come up with something.
They got to save face. Sorry, save face.
Yeah,
not shave face.
They got to shave their face too.
But they got to save face in that forum of where all the leaders of the world are there. They need to get brownie points from everybody.
And I think Trump wants the stock market to rally. So I think that they're going to come up with something. Do I think? But this goes back to my other point. Do I think there's going to be a real deal where they actually come up with something that matters? No. So I'm a seller that any real deal or any sort of real agreement that causes any sort of conclusion to these problems with the tariff.
I saw a statistic that these bankers that were looking at the odds basically gave something like only a 5% odds that there was going to actually be a meaningful trade deal that came from it. So really, we're going to just see some positive rhetoric, and it will probably fade within a week. Well, let's see what happens.
Sounds good. All right, Patrick. Now on to Tales from the Trading Desk, and I think you have a gem for us, so why don't you shoot?
Okay, so we're going back to I probably, let's say 2005. I was still working at the banks, and at the banks, you either traded with your bank or you had to go to some alternative places because of all the compliance rules about trading at other institutions.
In 2005, you were still allowed to trade. A lot of these guys that I know on desk, they have to hold things for 30 days, and they're not allowed to trade at all, basically.
Sure.
Yeah, it's
And so one of the things that we were able to do is open these offshore CFD trading accounts. And when I say offshore, we're not talking about millions of dollars. You would fund a $10,000 trading account.
Why don't you tell people what CFDs are?
So a CFD is a contract for difference. And so rather than trading the actual underlying futures or stocks, the dealer would turn around and offer you something that pegs the movement of that price. And by them not actually trading the underlying, they didn't have to follow the rules in terms of margin requirements and other things that other kosher or more established brokerages had to follow.
So it was basically just a bet on the future stock price on the stock exchange.
Right. So
whenever I heard this, by the way, when someone explains CFDs to me, all I can think about is Jesse Livermore when they used to work in the bucket shops, and that's what they did.
CFD dealers, in one degree or another, are bucket shops.
That's right.
Of the old days.
That's right.
And so I opened up, and it eludes me what the name of that. I'm gonna make something up. I don't know, but it was this Forex dealer that offered CFDs out in Ireland somewhere, and I opened up a trading account, and I bought a stock that had a big dividend, but I was trading it. I wasn't actually trading the dividend, but actually, let me explain this first before I get to the story. So here I have a chart of Verizon. And I chose Verizon because it was actually Verizon in the story. But this is going back to just October 9th of this year. And what we have that happens in the market to remove arbitrage and other things like this, when a stock pays a dividend, for instance, everyone on record on ex-div date for October 9th, when there's a 60-cent dividend being paid, once that is stamped in, the stock usually opens about 60 cents lower the next day. It's just an ARB thing that they do.
Well, yeah. What happens is everyone that owns that buys the stock the next day no longer receives the dividend that they would have gotten if they bought it the previous day. So if you're a buyer, you would naturally reduce your amount by what you were willing to pay by the amount of the dividend.
Right. So,
and in fact, many brokerages will automatically go and reduce your price. I don't know about automatically, but in my day when I worked as a discount stock brokerage, we used to go and we used to actually reduce it on the ex-dividend date so that they wouldn't get filled.
Right. And so the point being is that the market corrects when a dividend comes in. So going back to the CFD dealer, I basically went in there, and it wasn't a big position at the time. It was just I don't know, let's just say 500 shares of something, and I bought it, and then the stock drops on its ex-div, and then I look, and they didn't credit me the dividend. They basically
rooked you.
I absolutely I got welshed properly by a bucket shop, right? And so they didn't and so I'm like thinking, well, this has got to be, here I'm still a rookie at this time, but this got to be an opportunity to do like some sort of an ARB.
Like a good trader.
Absolutely. Like a good trader, I see an opportunity.
You get picked off and you think, I'm going to go the other way.
Yeah, I'm going to go the other way. I'm going to play. So I went and I opened up a second CFD trading account at a more established, more reputable CFD dealer, CMC Markets. And I knew that they basically accounted for the dividends and actually credited to your account. So I basically said, okay, these guys are offering me like 10% margin to carry these positions. And so like money in my left pocket versus right pocket, I basically go in and I go long like 5,000 shares in the CMC Markets account.
And that's the account that'll pay you the
dividend.
I'll
pay the dividend. And then I went and I shorted it.
And the
other
same
one. 5,000 in the other account. And I just carried enough margin to do it. And it worked. And I literally walked away with like something like $2,000-$3,000
for no work.
For no work.
Perfect
and
arbitrage.
I thought I could quit my job and just do this for a living, right? Like, I could turn around and just screw these guys over. And so what happens? Like 2 days later, I find another stock. The same thing happens. And so like here I go. I'm going to turn around and I'm going to go and give it another shot at milking it. And of course, once you burn the dealer like that and they realize that just came out of their P&L, the second time I tried it, they closed the window. I got the memo.
Well, so they sent you an email.
They sent me an email and said that they're going to have to adjust it for the drop of the thing and the cost, because the dividend was being paid in the other account. They just had to drop the value.
I was worried it was like Las Vegas where they take you out back and put your hand in the knuckle in the vices the vice and break your hand or whatever.
Yeah, no, I didn't make money on this thing, and that ended my one attempt to ARB the system.
The system. Well, that's a great story. Now,
bucket shops, they still exist.
I wonder if Jesse Livermore did that.
Yeah, I wonder too. Let's move on.
Okay, Patrick, it's now time for the top 5 things to watch next week. But before we do that, let's review all of our good/bad calls from last week.
Right.
Okay, so let's start with number 5 because I think that was yours. That was one of yours.
Yeah.
The
Euro USD hold.
Yeah.
And it so far it did. But the US dollar remains very strong. And while the euro has not broken that level, it's still game on for this.
And the U.S. dollar is strong, and especially considering the fact that Powell did go what I believe is to be a dovish bend. It's actually shocking that the U.S. dollar's hung in there as well as it has. So let's go on to number 4, GE credit spreads. Would they stop blowing out, and would GE finally stop shitting the bed? And the answer is no.
The shit just came coming.
Just bad. GE, it's just kind of they're the only thing worse than GE might be Deutsche Bank. And
yes. Oh my God. You and your. But by the way, let's just clarify. We had a bet, did we not? When you wrote that blog on your little macro tourist blog,
my little macro tourist blog, I like it.
And you went in there and you were gonna take the long or short against, and you bet on the long side. And within an hour of you publishing, who gave you the call?
I think you did, and you said sold to you, and it's been a good call to sell to you. Deutsche Bank is the only stock that might be worse than GE. I see that they were rated earlier this week, and then they were
rated at 5 of their board members. Right?
Yeah, and then that wasn't good enough. They rated them again this morning. It's like the truck that ran them over was kind of worried that they were moving a little on the road, and they put it in reverse to run them over again. It is just being the only positive I will take from this is like how much worse could the news get? Like this is we got to be getting close.
Well, I wonder whether Chanos is short Deutsche Bank.
He probably is. Okay, let's move on to number 3. Will NVIDIA head back to its 2017 lows?
So far, the support is held on NVIDIA. You're getting a little bit of a gap fill. Actually, I'll pull up a very quick chart just to show everyone.
I guess with the market rocketing higher.
I think this is purely a market response. After the stock wipes out 50% in just over a month, you're going to get some sort of a dead cat bounce. I mean, to be honest, a dead cat bounce should theoretically even go surpass 200. But I would certainly not be pressing that too hard. You don't want to be stuck holding the bag. The best way, and I know I talked to a number of my members about this, but putting on the debit spreads is one of the best ways. Earlier in the week, putting on like a 180, 190 spread was just a couple bucks, and you could turn around. You could make a 300-400% return on your spread, on a $10 spread, and if the whole thing blew up, you're out a couple bucks. I think that you have to be tactical about the way that you approach this from fading the gap, but.
The gap, it doesn't, although it's rallied, let's face it, the gap is still holding, and it's not.
The gap it fill is all the way to 200. I mean, this thing needs 30 more bucks.
Yeah,
that's a big move.
Before you can get excited about it.
Let's be realistic. It went from pretty much 300 down to 150.
Well,
140,
but
right?
my point is that if we have a market that's screaming higher like it has
and this
week,
is all it's got?
Yeah.
Oh, it's going to be the chart of death.
Yeah.
It's going much lower. So number 2, will the crude oil pain stop?
Well, the pain might have stopped, but I don't know if it's healing at all. It's still.
It's all about G20, and which is actually we should combine 1 and 2 together because.
Do you really think so? You think that the crude oil is about G20?
Actually, I've read a number of stories that basically said with Saudi Arabia at the G20 that the talks between Russia, Saudi Arabia, and the United States and so on that's going to actually happen there may be more important than OPEC.
Well, that could be. To me, I'm actually more interested in if we can get the U.S. dollar to go down, and if we get Powell, as we went back and I showed, I think that it was all the same trade. Yeah. And sure, there might be some supply issues, but I think the demand got hurt because the reality is that the Fed pushed us over in the economy into a contraction, and will they be able to stop it by pausing? I don't know.
All right. Well, we'll touch on number 1 because it's going to stay in our main list. So let's touch on number 1 in a little bit.
Well, for sure. Let's move on to the top 5 things to watch for next week. Okay, Patrick, you got number 5, so why don't you lead off?
All right, Kev. For number 5, I want to watch still a derivative of the U.S. dollar trade that we've been talking about for 3 weeks now, but I want to focus here on the Canadian dollar here for a moment because like many of the other currencies, the U.S. dollar has been very strong against the CAD. Depending on where you look at it, when we're looking at the USD CAD, which is the common Forex pairing, we're testing that 133.5, 134 level. I commonly like to look at this as the in Canadian dollar terms, which is testing the 75-cent level on the Canadian dollar. Same chart, just up the reciprocal.
That's right.
And
as Canadians, we like to watch it the other way. But
exactly.
Everyone else
I watch it. But what I'm looking at is the Canadian dollar hold the line? From my perspective, we had a NAFTA deal. We had all sorts of things that weakening. And with the oil break, naturally, the Canadian dollar has had a very strong correlation to oil, almost as strong as Russia, the ruble, has had. And the fact that oil broke as badly as it has, and the Canadian dollar has not plummeted to new lows, is surprising to me.
Yeah, I hear you. Is it just kind of the market taking its time, or let's face it,
will it hold?
And the other thing is that
I'm bearish. First of all, I'm bearish to Canadian dollar.
You are, so you don't think it holds?
I actually all year have been targeting 72 cents, and maybe I'm running out of time. 30 days left.
That's because you're always the big Canadian real estate bear. You're always so negative on it.
You know what? I don't know why, but I think it's because I find bulls so irritating that I naturally, you know what, I'm a risk manager by nature, and by doing so, I'm always looking at what can go wrong, and therefore I always see the negative things.
Well,
right?
And being a Canadian, you actually see it more often than not. So you can sit there and you can look at New Zealand or Australia, and it's because you're not getting bombarded with news every day about all the bad things that are going on there. So you have to be careful because there is a tendency for people to have there's home regency bias, and there's there's that same home regency bias in terms of seeing the worst in the country that you're living in. And
Grass
I think
is always greener on the other side.
Yeah, and I think there's a lot of Canadians are prone to that. And so I don't know if the CAD's going to hold. I'm hopeful that oil this dip is temporary. The other thing that's scarier than a WTI chart is the WCS chart, which is the Western Canadian Select Oil chart.
Like, was it at $12?
Yeah, it's just ridiculous. The only good news that I could say is that I saw that the NDP leader of Alberta, which NDP for our non-Canadian listeners is they're left of the Democrats. They're the Socialist Party. They're buying rail cars to ship the oil. And I was just like, oh my God, like John Galt would be just rolling over in his grave at hearing that. It's just kind of crazy. Anyway, so let's go on to number 4.
Number 4. So Kev, what is number 4?
So we have on Friday the big jobs number, the employment number. Yeah. And if we're correct that the Fed is pushed to a point where the economy starts to stall, and it's not just something that we're seeing in markets, but something we're seeing in the actual economy, then this might be one of the cases where that pops up and really forces investors to take notice that the economy is
So here is the chart of the civilian unemployment rate in the United States, down at 3.7%. And this is where all the people like you that are getting all wage inflation wonky are really fearful of the circuit. But like, we had a pretty crazy trend. Like, let's be realistic. This is crazy. The fact that unemployment rate is this low. But
what's even crazier though than that is that we haven't had any wage inflation. And as wonky as you claim I am. You're being right. Like, there's been very little wage inflation, and
because in my mind, labor has no pricing power at this stage. With the anyway,
well,
that's a whole conversation.
I think though that this number is not correct. That the underemployed and
oh my God, this is out of all of the economic data, this is the biggest political fiction.
Yeah,
but
but regardless, we're still going to see it, and it might be fiction or not. But
what I do want to point out is that when these trends change, by the way, it took into the middle of 2000. What is that year? That's it was late 2007 into the first part of 2008 for you to see the uptick. But once
the uptick in unemployment,
the uptick in unemployment.
Yeah.
But once it upticked, it didn't stop.
Yeah,
and that's common.
Right.
Like, once you see the change in the trend, it just doesn't stop. And the question, and you can see that this is why it's so important to ask the question, when are we going to see the first uptick here? When is the potential starting point? We've seen that in credit markets in terms of credit risk. Question is, when will we see it in unemployment?
Well, maybe this Friday.
Absolutely. Let's move on. So number 3, I'm watching in Canada.
Okay.
All right. And now this is a little bit of a fun one because you're the one who brought up Encana a couple of shows ago because you, in full disclosure, have a position.
That's correct. I am long and wrong on Encana.
You're long and wrong. Because I want to make sure everyone knows that you are long and wrong.
Long and wrong. And by the way, I saw the other day that Steve Cohen's .72 is also long and wrong with me. So at least I'm with
good company. Good company. With that said, what is really interesting to me is that this is still a very big established Canadian nat gas company. And for it in a month, first of all, let's be realistic. Natural gas didn't get killed. It went. Oh, now the spot prices went up, but the curve itself, the longer dated curve, didn't crash with oil.
Well, yeah, but a lot of people are looking at the spot, and the spot's up 100 or 50%.
Right. So,
but you're correct to point out the fact that the curve, which is what these guys price off, barely moved. So it's unchanged.
So really, in my mind, Encana got sold with a basket.
So let's go back though. It's not because I think you're missing one part. See the big gap down?
Yes.
That's when they announced that they were going to buy NFX, which is
so this is like a ConocoPhillips CVE kind of scenario.
So the market was very disappointed in their announcement of the purchase. They had seemed to have indicated that there, or at least speaking to different traders, there was some indication that they believed that the Encana was not going to buy anyone, that they were going to stick to their knitting, they weren't going to do anything like this. They have had some disastrous kind of purchases in the past. They're the stock that everyone hates because they've been just so poorly managed, and they've just
in the 2014 period they took it on the chin pretty bad.
They bought some terrible things.
Actually, I'll put it on a very quick weekly chart just so everyone can see how bad it got back then. Right back then, Encana went from a high of $50 down to $4, right? Like it was a 90% wipeout, and so a lot of people don't forget shit like that, right?
Yeah,
and so the thing that we are still long ways away from $4, but there is no technical supports that you can establish.
No squigglies.
No squiggly little defending support lines the way biotech's held last week.
Wow.
And I'm long biotech. Thank you very much. So that let's put a notch in my corner there. But with that said, what was interesting was that how low will this go? To me, it wiped out 50% of its value in a month. No, a month. Okay, let's call it just under 2 months.
Yeah, the pain's been brutal.
Will we see a NVIDIA-style gap fill?
You're asking the wrong guy. As I told you, I'm long and wrong. I think it's ridiculous. I think it's dumb. I think the market is punishing them way too much, and I'm hopeful that it was just it was selling with the rest of the energy patch, and that it might not be quite as bad of a purchase as everyone is worried it will be. So anyways, let's go on to number two.
So what is number 2?
Powell. So I can hear it already. I was listening on the way here, and people are already saying that the Powell's going to go and he's going to walk back his comments because the market took it too dovishly, and he didn't really mean that, and he's going to go back to his hiking, and he didn't really mean all this, and I'm just going to call it BS. He put the market exactly where he wants it to be. They're sensitive to different. They're data dependent, and that's all there is to it. They've stopped hiking every second meeting. They're now going to take a wait and see approach. He's speaking on Wednesday. Expect nothing different. Don't go if someone starts saying he's going to say something different. Just tune him out. Because he's not going to say anything different. The worst thing he's going to do is flip-flop yet again. He made a mistake on October 3rd by being so hawkish. The market, as we
punished
said,
him for it.
Punished him for it. He's walked it back, and everything is fine. He's going to stick to message now. Nothing's going to change. And on to number 1. What do you think?
So number 1, we are just going to do a throwback. In theory, we really shouldn't have had the G20 last week because we knew we were going to record the show before the G20, but it still remains the single most important thing to watch. Now, the thing is that by Monday, we're going to already see the reactions in the market. And I just feel that rather than, because last week we covered all the kind of things to watch for, in my mind, I think what I want to just leave people with on this meeting is I really feel that there could be a false start reaction, because you have to think that everyone generally has a sense. I feel that everyone, you can push back on this if you think, but I generally feel everyone is expecting them to come out with smiles on their faces, and the photo op of them shaking hands like things are going to be good. And I feel that there's a real chance that the market is going to start strong out of the gate, thinking that everything is fine. And I have a feeling that a week or two from now, when we look back, it's going to have been a fake out.
It's going to be a prairie dog.
Prairie dogs you have to make new highs, sort of.
Oh,
right. Like
the prairie dog is. Well, to me, it is going to it would be a new
fading the move.
So you're saying a prairie dog technically, just so we got our technical terms right on the prairie dog. It has to be like a new 52-week high, or what?
Like what you want is that there's a major overhead resistance that's been rejecting, and then suddenly it pops its head above that line in the sand.
Okay.
It kind of looks around and then rejects it. Now, it doesn't just happen everywhere. It has to be at a technical level. But fading the buy on rumor, sell on news kind of thing on the markets. I don't know whether you suggested it could be one of those things where by the afternoon they're fading it, but I think there could be multiple days of move. But I think if you go 2 weeks forward, I think that everyone's going to regret having bought the positive news.
So you think a pop and drop, but you just don't think it's going to happen in one day.
It's not going to happen in one day. But
Well,
I think and we'll stress test this going in, because obviously with the Fed meeting on December 19th and this meeting right here in early December, there's lots of wiggle room between the two things.
And we have the famous Santa Claus rally. There's a million things going on, but I don't know. And not only that, more importantly, we have to come up with a name for this. This new chart pattern. So we have the prairie dog, the pop and drop. So if anyone has any good ideas, please pass them on.
That's for sure. Just email us. Kevin, let's go to the parting trading wisdom. What do you have?
Well, we spoke about Jimmy Chanos earlier, and he's one of my all-time favorite investors, as I mentioned. And for the longest time, he was very bearish on China, very bearish. And at the time, it's hard to remember, but in the early or mid 2000s, China could do no wrong. Everyone thought that they were just forever going to grow at 8%, and they were the cat's meow. Well, anyways, he got bearish on China, and some people started to give him a hard time about it. And one of the big complaints was they said, Chanos, you've never even been to mainland China. And his quote, his response, his retort was just classic. He says, yeah, well, I didn't work at Enron either. And it just made me laugh so hard. Jimmy Chanos is just like awesome. Well, hats off to you, buddy. That's a great line.
All right.
So now on to it's been great spending some time with you, Patrick. I've really enjoyed this. I hope everyone else has as well.
Yeah, everyone, please send us your feedback. We are always trying to make the show even better. Those of you that are enjoying the show, follow us on YouTube. Just hit the subscribe button. Otherwise, please share this with anyone that you think would enjoy this show. We want to get as much exposure as possible.
Right.
Any parting words there,
Well,
Kev?
I just want to thank everyone for spending the time with us. I know that there's lots of different shows out there, and we enjoy doing this, and I hope you guys do too. And don't forget to visit our website at markethuddle.com. It's not .con, it's .com. And sign up. There is a spot there to receive a weekly email. Right. And we're never going to spam you with junk, and we might not even send you something in a week because we didn't get around to it. But our goal is eventually to have a kind of a weekly kind of email that goes out that has all the charts and things of
all
that nature.
All sorts of the cool stuff that
That's
follows
right.
up with and also notify you when all our new content is coming out.
That's right. So anyways, and just, a final shout out to our sponsor, Cowbell Brewery.
It was a nice beer.
It really was, Shindig. And, you can never have too much cowbell.
You can never have too much cowbell. Anyway, thanks everyone for joining us, and have yourself a great week.